retail number, but not too good?
Yeah, I think there's a couple things. One is the retail number, because it shows that the economy is slowing but not broken. I also think this UMich survey was a big deal because it's corroborating that not only is gasoline down and the commodities down, but now consumer expectations of inflation have rolled over. Market expectations of inflation have been anchored. I think this pushes the Fed to be more measured, and we heard some of that comment yesterday. And finally, I think it's good news that stocks aren't getting obliterated every time we have a bad CPI print.
Make the argument for me, if you would, Tom, that this is not a sell the rip market, that I shouldn't, if I have some positions that I still want to get out of, that I shouldn't take advantage of a day like this and do just that.
I think the majority of people want to sell this rip. The reason I would say it's different is, unlike every pretext for the past few months where commodity prices were soaring and consumer inflation expectations were soaring and market-based inflation and interest rates were rising and even Fed funds hikes were rising, a lot of these are stabilizing or rolling over, which means this is putting the Fed in a position to go from being expeditious, chasing hikes, to being more measured. That's a huge deal for markets because now it gives markets a path to sort of see where rates will be. And keep in mind, in 80, 82, the stock market bottomed more than 3 months before Volcker sort of abandoned his Volcker moment policy. So I think that's why stocks are in a different place now than they were a month ago. And I actually think that's why second half could be quite strong.
But even your own technician, Mark Newton, was suggesting just days ago, literally, that a new low was coming. And maybe the second half was going to be good, but not until you hit a new low in stocks. You sound like you're telling a little bit of a different story here.
Yes. And, one thing that Mark's been very consistent about expecting a lower low into the end of this month, end of July, is that that's going to be a touch, that he thinks that we might momentarily peak below the prior lows, but he's buying that because it's not the start of a new downtrend. And I mean, to me, that's the message. I don't think we're talking about accelerating downside. I mean, we've had earnings misses and companies aren't falling. I think that the upside risk is much greater now than the downside risk.
But do you agree with him that we're going to put a new low in? You painted a picture at the beginning of our interview here that suggested otherwise.
I'm not great short term, so if that's Mark's belief, I would defer to him. But do I think stocks have a lot of negative shock still in it? It would have to be the belief that the Fed suddenly feels urgency to go much faster. That doesn't seem to be priced into fixed income at all. So I'm in the camp that stocks have bottomed.
What about this idea of 100 basis points, right? It was sort of Bostic kind of got everybody all worked up, even though he's not a voting member, with his everything is on the table commentary from a day or so ago. Waller came out and talked everybody off a cliff. However, SocGen, RBC, Citi, Nomura, Piper Sandler, everybody's talking about 100 now.
Yeah, I think what's interesting is there's talk about 100, but it's not raising the terminal rate. So people are just talking about putting more another 25 into July, but it's not raising where the Fed sort of peaks. And I think that's more important. If the terminal rate isn't rising, then 100 or 75 isn't really changing what it means for equity prices.
But the CPI was bad. And the suggestion was from people like Steve Leisman, for example, that you need to reset the clock. Last CPI was bad. This CPI was bad at a time where we had hoped for some moderation. If that does anything, it forces you to reset the clock about when the Fed may be a little easier than they are now. So what happens to your thesis about a strong second half if they have to go stronger in September because inflation is still red hot?
Yeah, Steve makes a great point, because the Fed needs to see a consistent and meaningful move down in inflation. But we also have to remember CPI is the last thing to capture that, because commodities are already rolling. Oil's back to pre-invasion levels. I mean, wheat and copper are lower. The markets-based inflation expectations are actually lower than they were any time at the start of this year. And now consumer confidence inflation expectations are rolling over. These consumers are already experiencing the rent and the things that are making CPI hot, yet their inflation expectations are coming down. So I would say if you see all this soft data pointing to a downturn, the Fed doesn't have to wait for CPI to get to 2 or 3 before they realize momentum has already shifted in inflation. So I would say I'm in the camp that the Fed has more room because the market's done so much work for them.
Do you think we'll see enough of a material change in the things in inflation that matter the most to cause the Fed not to be as aggressive in September?
It's a great question. If you look at sort of inflation and what's sticking to script, things like travel, cars, gasoline, they are rolling over into the next few months.
Well, I could read you 10 different parts of inflation that have rolled over substantially. However, it's the rent aspect that hasn't. So if your cost of living on just living is high, you're feeling lousy.
Sure. But my point on the rent is, if rent is causing inflation expectations, the UMich consumer confidence surveys would show it, meaning that people should then say inflation's accelerating because their rent is, but in fact, consumer confidence inflation expectations are rolling over even as rents are going up, meaning their expectations are pretty anchored. And I think that the CPI is just capturing home prices take time to roll through and the base effects. I think it's a lagging indicator. And in fact, I'd say the sequentials are going to matter. And as you know, month over month, it's going to start being under 2% annualized from August all the way through February.
The other elephant in the room, I mean, we need to address is earnings. And, we made a big deal yesterday when Savita Subramanian of Bank of America, you know her, I mean, she's well respected. She finally capitulated a bit on her target for the S&P. You haven't really. She capitulated on her outlook for earnings. You haven't really. Why?
Well, I think earnings this quarter are really highlighting, too, how bad expectations have become, because unlike prior quarters, misses aren't resulting in big sell-offs. So that's a huge change in the reaction function. The second is, consumers and businesses are holding up spending better than expected. And I think that means, despite what looks like the economy hitting a wall in the first half, earnings are still growing. I'm just in the camp that a soft landing is still a stronger narrative, even if the market believes it's a recession.
Well, I mean, you're not the only one to think that, right? I mean, Bullard was making comments today suggesting that, he still thinks it's a possibility. Let's broaden the conversation now, bring in a few other voices. CIC Wealth's Malcolm Etheridge with us, along with Axonics' Peter Cicchini. It's good to see both of you. Peter, you, I hope, heard what Tom Lee had to say, that you shouldn't sell the RIPs, that maybe this time is different. You would suggest otherwise?
Yeah, I would. I've been in the seller rally camp for the majority of this year, and I don't think, unfortunately, I don't think that's done. I think as we go through this earnings season, we could see a summer rally as companies post earnings that are just good enough, given how negative sentiment had become, to support higher prices. That said, I think where we start to see the weakness is in the guides into next quarter. So we've had multiple compression to start on higher interest rates. That was the story up until now. And I think the next part of the story is cash flows. It's lower earnings and lower guides. And that has not been built in to most people's forecasts. And I think that takes us into a 1970s kind of paradigm where we could see something significantly greater than a 20% pullback.
Interesting. Malcolm, I'll get to you in just a second, but I want you to respond to that, Tom Lee.
I mean, I wouldn't expect companies to have a lot of visibility, so it's not a surprise. But are delivered numbers coming in better than expected? Yes. I mean, even today's retail sales is a positive surprise. I think that there is a very large gap between the level of gloom that's out there, market expectations, and there's room for companies to miss and guide down because how much expectations have fallen. I mean, Russell's a great example. The Russell 2000 earnings are up 70% since 2019. The Russell index is flat. So you have 72% more earnings behind a flat index.
Malcolm, gloom and doom or no?
Yeah, I think my main concern here is that the Fed starts to share the same sentiments as perma bulls like Tom and eases off of the gas pedal a little bit as we start to look at the July and then September rate numbers. I really think we need to be talking about 100 basis points here, but I'm very concerned that, one, they start to ease off because, like Tom said, they start to feel like the market's done some of the work. And two, they start to not want to look like they're capitulating to the markets and not being reactive to the markets by going to the extreme 1% and instead go 75 basis points because it's a lot more palatable and really already expected by pretty much everybody on the street.
I'll let you respond to that too. I mean, that was a little bit of a zinger he threw in there, but I mean that is the criticism, is that you're ignoring some of the issues that Malcolm and Peter have addressed, and you're in your own sort of world here about why you think that the stock market can do as well as you think it can.
Yeah, that's a great question. I think the market has sort of a very central narrative that we have a hard landing coming and inflation is very sticky. The data in June is kind of proving the point that inflation's not that sticky. Even in consumer expectations, it's not de-anchoring, it's actually coming down. And I would actually kind of push back a little bit and say I think the bubble is in hyperinflation fears. I mean, that's the bubble that's bursting, not uber bullish bubble. You know, the market's already down. So I think the belief that the Fed has to do this for years is actually sort of the bubble.
Malcolm, why don't you respond to that?
Yeah, I don't know. I don't know what numbers Tom is looking at to get so bullish here and to feel so positive, because Scott, I think you made a really good point initially, which was that housing is the big concern here when we look at the CPI numbers, right? The only way we're going to get inflation anywhere near under control is to bring housing back into a realistic number, and then also autos like right behind it. And the only way we're going to get housing under control is if the supply of homes available for folks to buy suddenly somehow increases by millions, right? We're behind like 5 million houses, and that's the only thing that gets people to stop renting, that gets landlords to stop gouging people on rent. That's the only thing that's really going to drive that CPI number down in a meaningful way, that says to the Fed, mission accomplished, we can ease off here and stop raising rates to the point that we have. And then, oh, by the way, mortgages are twice as expensive as they were 6 months ago because the Fed has had to raise these rates. So it's kind of just this vicious circle that I just don't see where the optimism comes from here.
Yeah, Peter, it sounds to me like you don't either. I'm wondering what you think about the 100 bips question, whether, you know, the Fed is going to be more aggressive than some like Tom think for the very reasons that Malcolm just articulated.
Yeah, one of the things that's been a bit surprising is the reactivity to headlines of late. The CPI print at 9.1% was basically at the whisper based on the folks I'd been talking to. So I was somewhat surprised that the Fed funds futures markets for July started pricing in 93 basis points right away. Then it didn't take much. It took a little bit of a walk back by Waller to talk about a 75 basis points base case. And now here we are under 80 basis points for the July hike. I do think the big risk here is, in fact, that inflation has been rolling over slowly. No one talks about PPI, but PPI was one of the reasons why at Exonic we were ahead of the inflation story and thought it was not transitory early on. PPI has actually started to moderate somewhat. Inflation in goods has transferred over to services because of the way the value chain works. Commodities have started to roll over for two reasons. One, because of the Fed, and two, because inflation kills itself. When prices go up, people buy less. We've been seeing that in the data. So I think the biggest mistake would be for the Fed to go too hard based on the fact that a lot of the data is saying inflation is cooling. That said, the important counterpoint there is that OER always follows inflation with about a 6-month lag. So rents are likely to be sticky for some time, as are various parts of the services market. And so the Fed also can't be asleep at the switch. It's a very, very tricky spot.
I just want to make sure people know what we're talking about. Owner's equivalent rent, just so these acronyms have a place to settle with our viewers. Let's do this. Malcolm, let's get a little more critical on where you think we should be. You like cloud stocks. I like the debate on tech, especially now, after ServiceNow raised the issue of currency. And I think the direct quote, or certainly close to it, from the CEO, and it may have been on this very network with Kramer earlier in the week, was it's impossible to outrun what's happening in Europe with currency issues. So why shouldn't I be more concerned about that and like these stocks?
Well, I mean, that is a fair criticism, and I think especially when you think of the multinationals, right? So the giant behemoths that do business on basically every continent, I certainly understand the concern over currency risk, but I definitely still think there's opportunities in cloud simply because companies have finally at least started to look like they're accepting the fact that employees are never going to come back to the office in a meaningful way, physically, the way that they did before. And so instead of trying to onshore or keep onshore all of their data, they're migrating all of their data to the cloud now instead of just siloing it and deciding to keep some stuff, in-house because, certain employees need access to certain stuff. And so I think what that's going to do, that demand for cloud storage specifically is going to increase M&A activity among some of the larger companies like your IBMs and your Salesforces, who are number 3 and number 4 players behind Azure and Amazon Web Services. And those companies are going to come in and gobble up some of the smaller players at the bottom of the field that have lost 80%, 75%, 70% of their stock price through the course of 2022. They've lost a significant portion of their stock price, their value, and they probably are going to be willing to play ball. So just from an M&A perspective, I think there's going to be tons of opportunity for folks looking to increase their market share as far as cloud computing services are concerned.
Let's talk tech, Tom, because you like it, and you've been advocating mega cap tech as part of your overall strategy. I note Apple closes a touch above 150. Stock was below 130 for a moment, not that long ago. We're 10 or so days away from big tech earnings. Are we going to be disappointed? Is this a run-up that's going to be a sell when they actually come with the numbers?
I think tech is still better to buy into earnings because, number one, it's a group that peaked early. It peaked several months before the S&P did. It's really been one of the source of funds because it's the one thing that wasn't nailed down and easy to sell early. And it's also, I think, very consensus to kind of want to be in value and inflation plays. But if we're at the cusp of disinflation and the Fed cooling, I think one of the biggest moves is going to be the NASDAQ. And everyone says after a crash, you don't buy the groups that led. But every single post-market bottom since 1986 has been led by tech. So I think tech is still the place to be.
Peter, why don't you respond to that? Do you agree or disagree? And I just note, again, this move by Apple has been somewhat, stealthy. It's been a nice little move here. Does it have greater meaning?
I would say you've got a great barbell here, Scott, because you got tech on one side, then you have what I like most, which is a defensive sector. It's called real estate. And because, for example, rents continue to go up and are likely to continue to go up, exposure to multifamily housing is a great defensive area. It's not equities, it's structured products for us, for example. But I do not like tech here yet. I think the assumption that we've had a bottom in the markets is wrong. Tech does tend to lead out of bottoms, but I think we're actually far from the longer term bottom. Again, the analog is the 1970s. We've got further to go, notwithstanding, some pretty aggressive rallies in the meantime, which I think we're on the cusp of having right now.
All right, we'll make that the last word. I appreciate it, everybody. Have a great weekend. I know I'll see you on the other side sometime soon. Tom Lee right here with me, Malcolm and Peter as well. Let's get to our Twitter question of the day.